Assalamu alaikum, welcome to Study On. This is Samia Azizwati and you are here with me to learn about importance of financial markets and institutions today. So let's start our discussion with corporations. What is a corporation? A corporation is simply a kind of company that is created by legal laws or that is created legally. It has an existence just like as an artificial person. We can assume this corporation as a person, which is have its own name, or you can say it has its own identity. It is different from the other. It can it gets birth, it lives, and also it can die. So these are few features of corporation, just like as a person has, but this is an artificial person created by law. As there are public bodies, so they get registered, right? So once they are registered, so they have their shares or other financial securities circulating in the market, or any other financial security in the market, financial security or instruments. Now the question is that in case of the corporations, they have a huge kind of operations, because corporation is not a small firm. It has a huge operation to do. So from where they are going to manage the funds? So any company, in case of sole proprietorship, the owner arranges its own cash or own funds, which we call as the owner's equity in that case. So definitely corporations have their own funds, that are the funds by their shareholders, but also it's not it's not possible that the cash called from shares is going to be sufficient or is going to be enough to run the important operations of the corporation. May need an extra cash. So that extra cash comes from a group of people called debtors. Now debtors could be like banks or other financial institutions. To just fulfill the need of funds in order to run day-to-day operations of the firms, or we can say those operations can be exclusive or crucial activities or crucial activities that are responsible for existence of the firm. If we stop those activities, the firm existence could be in danger. So knowing all that stuff excites me to tell you about the arrangement of additional cash. So imagine that there are a group of people whom we call households. Now this group of people have cash in excess, or we can call as the cash in surplus. Now the thing is that they don't know where to put that cash. They basically through a financial market move their funds to the corporations. They give their cash to the financial markets and institutions. So and those institutions and financial markets send this cash to the corporations, because corporation need an extra cash, which can be in the form of loan or debt, right? Now Another group of people could be like investors. So these are the investors, or we call them shareholders. So cash comes in the corporation by two ways. One way is through date, other way is through ownership or through equity, and this altogether creates the capital structure. Now, what is the capital structure? It is basically a percentage of funds contributed by owners and debtors, like owners who own the firm and debtors who just to whom you owe the funds. So the thing is that suppose in a firm, if more than 60% is being contributed by equity holders or the owners, then remaining 20% is owned by debtors, and this is a very good criteria. But in a firm, if more than for suppose 40% is owned by debtors and then 60% is owned by shareholders, is still a good story. But if it crosses a particular limit, like it gets 60% of debtors and 40% goes for the equity, then this is a risky situation. This is another topic, that why it is a risky situation, but for now I have to tell you that this is going to be the risky situation. So always we have to keep the debt ratio low as compared to our equity ratio. So the movement of funds happens from the group of people. One is a form of investors and other is a form of equity holders who hold the firm's equities or firm's shares. As we know that the corporations do not operate in a vacuum, but rather they operate in an environment, right? So none of the organization can operate in vacuum. So they are operating in a financial environment. Now this environment has two crucial markets. It has financial markets and financial institutions. What those both part of this environment do? So basically they are going to help the organizations, help the corporations run their operations without delay. Why I say that? Because when you are out of funds, you delay your activities or operational activities. So with the help of these both markets and financial institutions, your business can do whatever it was doing and without any interruptions or without any difficulties. So we will study in depth about the financial environment and financial markets. What are the types of markets we are dealing with? What are the financial institutions according to the their names? We will understand, we will study their names and their types, and also we will understand their connection with the corporations and how they are helpful to the corporations. I hope this lecture was helpful. It was a short lecture and about an introductory lecture about the corporation, and in other lecture we will continue understanding about the role of financial markets and institutions in life of a corporation. So thank you so much. Allah Hafiz.